Howdy, Jacob here. Today we're looking at Casey's General Store, consumer staples distribution and retail industry, just above 13 billion market cap on just under 15 billion enterprise value. Together with their subsidies, operated convenience stores under the CASY, whatever general name. Yeah, headquartered in Iowa. They were heavily, saw them a bunch in the Midwest when I lived in Snowda, Minnesota. I mean, they're a decent place, I guess, but I really just got gas there, so I didn't really do much else. Growth is way more than I thought it was. We're looking at 7.8 billion in 2015 and to 14.9 billion in revenue in 2024, with margins that are very dampened. Yeah, that's no surprise either. Operating margin low to mid single digits, gross margin maybe 20%, but surprisingly, at least surprisingly to me, return on invested capital in the 10-11% range. So that is fairly impressive. Balance sheet shows 206 million cash on hand with 53 million short-term debt, 1.6 billion long-term debt. A lot of net debt here, 1.6 billion, but in relation to cash flow, that is about 4 years. 4 years of their, let's say, 4-year average free cash flow. So that's not a terrible amount. Huge acquisition here. It really bumped up their capex, bumped up their cash flow operations a little bit, but heavily bumped up their revenue. When you make acquisitions, you want to make efficient acquisitions, especially when you're a company that's been around for a while. You want to increase the bottom line and focus on that. You don't just want to increase revenue, because you as the shareholder should care about earnings and free cash flow, not just revenue. You don't get anything from having extra revenue. Good for you. If it doesn't hit the bottom line, it doesn't really do much for me. But anyways, their use of cash is heavily on acquisitions. Their dividend of 0.5% pays out 60 million, which is not a whole lot of their free cash flow, maybe 15% or so. Buy back a little bit of shares, pay down a little bit of debt. But again, majority, probably well over 50% is going towards acquisitions. So let's start making some assumptions here on the revenue growth side. I mean, with acquisitions, maybe 5%. I mean, I don't think it's really anything crazy special. So I don't think I need a immense moat or anything, especially with margins as low as these. Let's do 3, 2.8, no share change. Well, no share change. To offset stock-based compensation would be about 130 million. Or 1% would be about 130 million. To offset stock-based compensation, about 40 million. Of the last 5 years, yeah, they've really been doing much. So let's just say they offset stock-based compensation with about 10% of their free cash flow. Dividend paying out, let's say 15 to 20%. We can increase that. That's pretty low if they've been doing that historically, and it looks like they have. Let's increase that. And then we're saying, maybe 15% to debt, and then 50% to acquisitions to keep these margins and get a 5% return. Even with these assumptions, we're saying the company's stock price needs to fall 74% to get to the price we're looking for here. I will be patient, and I will wait, and I will review other companies in the meantime. Hope you enjoy the video and have a great rest of your day. Thank you.